Does stock size matter when it comes to diversifying your stock portfolio? Cue the music, cue the cool intro, because I'm going to explain this to you right now. So, does stock size really matter when it comes to building a diversified stock portfolio? The answer is yes. First, a quick introduction. My name is Mitch Goldberg. If we haven't met yet, I'm a financial advisor and I'm a business owner. This YouTube channel is about investor education, entrepreneurship, and business strategy, but today I really want to focus on investor education. There are three general size classifications of stocks: small cap or capitalization, mid cap, and large cap. Each one has its own set of unique characteristics that makes them different, and by having each one, it helps you prevent something called stock overlap, which is when you have the same stocks in each one of your exchange-traded funds or mutual funds. So let's get started. First, diversification. This is a strategy that we use to mitigate risk, but it doesn't protect your account from going down in a generally down market. So let's get into it. Number one, small cap stocks. These companies are typically valued at roughly $200 million, $300 million, upwards to $2 billion. $2 billion might seem like a lot of money to you and I, but in the world of stock investing, it's actually a teeny tiny little number. It's minuscule. Small cap stocks, investors like small cap stocks because generally speaking, as an asset class, they often show greater growth characteristics than mid cap stocks and large cap stocks. On the other hand, they do come with their own set of risks. They're considered riskier, more volatile, and their fundamentals aren't quite as strong as large cap stocks, which means that they're often, they don't have the same survivorship abilities during a nasty recession. Number two, mid cap stocks. Mid cap stocks are generally valued $2 billion, upwards of $15 billion. These companies are generally considered more developed than small cap stocks. They have typically a longer, more consistent history of earnings and revenues. They have usually have stronger financials than small caps, which makes them better able to survive a nasty recession. The downside is that many investors just aren't familiar with the names of many mid-cap sized companies, and they're not quite as developed, financially speaking, as their large cap counterparts. Number three, large cap stocks. Large cap stocks are what many investors lean heavily on for long-term appreciation of their assets, long-term growth. Large cap stocks are often the names that you've heard of: Costco, Amazon, Apple, for example. Large cap stocks often have strong fundamentals. They have a longer history of earnings and revenue growth, and they typically are the companies that are considered to have the fundamentals to survive a nasty recession. They often pay dividends as well. So there you go. You have small, mid, large, and they all have their own different characteristics. And when you have different investments with different characteristics, that's what creates diversification. The other way that having small, mid, large cap stocks creates diversification is that it eliminates something called stock overlap. So if you were to invest in these kinds of stocks, a small cap exchange traded fund, a mid cap exchange traded fund, and a large cap exchange traded fund, you wouldn't have overlap. You're not going to find Apple that would be in the large cap exchange traded fund in the small cap or mid cap exchange traded fund. So that it gets rid of overlap, and that's another characteristic that brings about more diversification to you, the investor. I hope this video helps. If you like it, if it helps make sense of this, please give it a thumbs up. Please subscribe to my YouTube channel, share it with a friend. You can reach me at mgoldberg@clientfirststrategy.com for more information. Check out our website, clientfirststrategy.com. And until next time, thank you very much for watching.